Welcome to the Chartered Financial Analyst CFA Level 1 series of video. As usual, I provide a slide about my qualification and experience. Today, the video number 9 on the corporate finance and equity. The topic we did in video number 8 is cost of capital. I would like today to give a short presentation about the cost of capital and the component of this formula, which we come across in the last video. The weighted average cost of capital equal equity plus the total finance times the required rate of return by equity holder, that is the cost of capital for the company, the weight of the debt times the required rate of return by debt holder, which is the cost of debt to the company, 1 minus tax. Let us see each component here and each letter and explain it further. The first one is the cost of equity, which is RE. Why I put it in red? We will know this shortly, but let us continue. Required rate of return by debt holder or cost of debt is the average interest rate of a firm debt, which is known from the financial statement. Companies disclose the average cost of debt as per their contract with the debt holders, whether banks, bondholder, whoever. It is well known. The other component is the tax. Companies also disclose the average tax rate they pay, normally between 25% to 30% in general, and it will be well known. The equity is either the market capitalization of the company, or if not available, as in the case of unlisted company, we take the book value as per the balance sheet, or similar companies market value, which will be known again from the balance sheet. The debt also, the total debt. If the debt has a market value, we'll take the market value. If it is bank loan which has no market value, we take it from the balance sheet, that is the book value. Now, the question is, from where we can get the cost of equity? If every letter here is known to us, how to get the required rate of return by equity holder? Or simply put, what is the cost of equity to the company, which in turn is the required rate of return by equity. Normally, any required rate of return depends on the risk profile of the investment, that is, the risk for the company as a whole. The market assigns a rate of return based on the perception of market participants about the risk associated with the share of this company based on their business and so on. To understand from where we get the cost of equity, as usual, I give very simple example, very simple calculation, so that everyone understands the basic idea. If in the exam you get any question, twisted question, if you understand the logic, the idea behind the formula, then whatever the question might be, it will be easy for you to understand. But it is always a start from basic, and some people might consider it naive. It is not. The cost of equity, we get it using the capital asset pricing model, or simply the CAPM. We all came across this equation, but I think some of you might not know that this is the basic idea of capital or cost of equity for the company. To understand the capital asset pricing model, it is simply how we assign price to the asset. assets that last longer than 1 year. This is why we call it capital asset. It's not all the asset. So a share in the company is an asset. How to assign a price of it is based on the risk profile, as I said, about the company. To understand how we get this CAPM, let us take a simple example of a retiree, somebody who spent his whole life working in a company and earning a lot of money. Just he keep that money in the bank and he has no clue what to do with it. The bank pays him only 2%, and he's happy with that because he doesn't know what to do with the money. So he's happy with 2%, a safe investment, because the bank deposit is generally safe compared to other product. Or treasury bills, they pay 2% on average historically, although now it's very high, but this is temporary. But on average they pay 2%, and we call it risk-free rate of return. Risk-free rate of return. It has no risk because the government, if you invest in the government bond or treasury bills of the government will not default in the risk. In the payment of interest and the principal. So it has no risk. So it is free of risk. This is why we call it risk-free rate of return. Now, if you want to convince this retiree to take his money out of the bank and give it to you so that you can invest it in your project, he will be worried about many risks. The first one, the risk of default. You might default by simply walking away from him and never pay him back. There is also the risk of business risk. Your project might fail. So there is myriad number of risk. I don't want to go into it because this is not the topic of today. But here, in order for him to take his money out of the bank and give it to you in your project, you have to pay him something more than the risk-free rate of return to compensate him from shouldering the risk with you. So you have to pay him a risk premium. That is, you pay him risk-free rate of return plus risk premium. So this will be your cost of equity. For you to put it in the company, you have to pay the investor risk-free rate of return plus risk premium. The risk premium is the amount you pay over the 2% risk-free rate of return. So if you decide to pay him 10%, that means you are going to pay him 8% risk premium. So you pay him 2% risk-free rate of return plus 8% risk premium. The total will be 10%, which is the market return. Please concentrate on this. The 10% is the whole market return, of which 8% is the risk premium and 2% is the risk-free rate of return. So normally I get 2%, you pay me 8% in excess of 2, that is 10% will be the risk premium. So the risk premium, we can safely say that the risk premium is the market return, which is 10% minus 2%, that is 8%. So this will be the required rate of return to equity holder. Let us put it in another way. The risk premium will be market return minus risk-free rate of return, that is 8%. So required rate of return or cost of equity is the 2%, that is the risk-free rate of return plus risk premium, which is market return 10% minus 2%, which gives 8. 8 plus 2 will give the 10%, that is the market return. So this is the equation. CAPM, required rate of return or cost of equity, equal risk-free rate of return plus market return minus risk-free rate of return. There is a catch here. Risk-free rate of return is plus and here minus. So risk-free rate of return minus risk-free rate of return is 0. So that means the cost of equity is always the market return, that is 10%. Given this equation, the answer is always required rate of return is equal market return. But that doesn't make sense, because not all the companies earn the market return, because the risk profile of all the companies in the market is different. Some companies are very small and very risky. Some companies are mature with huge cash flow, with huge asset, and generate steady income, steady cash flow, while other is still in their infancy. They call it growth companies. These growth companies still young, the future is uncertain, so the risk is different. So we need to compensate each company separately based on a risk factor that is not exactly M minus required rate of return, a risk-free rate of return, because in this way everyone will get the market return. But if my company is riskier than the market, I should get more than the market. If my company is less riskier than the market, I should get less than the market. So we need to multiply this by a factor. That factor will be more than 1 if the market is less risky and my company is riskier than the market. I will multiply by more than 1. Let us say 1.5. This will give not 8%, will give 8 times 1.5, which will be 12. If on the other hand, my company is less riskier than the market, then here will be less than 1. Let us say 0.9. 0.9 times 8% will give 7.2%. So I will get less than the market. So it all depends on the risk profile here, which we call it beta. Beta measure times the beta. We multiply the risk premium by beta. But what is beta? Beta, as I said, measures the risk specific to that company. If that company risk is more than the market, it will be more than 1. If it is less than the market, less riskier than the market, a stable company with a stable cash flow in mature industry, it has a monopoly, so many factors, then it will be less risky than the market. It will be, let us say, 0.7. 0.7 into 8% in our example will give 7 to 8, 48 or 56, 5.6 plus 2 will give 7.6, not the 10% market value, which we assume. So beta measures the risk specific to a company. How we do that? We see how the company retain stock, the share price, how does it react to the change in the market. If the market change 10%, if the company change also 10%, that means beta equal 1. 1 times this will give 8%, and I will give this equation will give 10% similar to the market. But if the market change 10% and our company change 15%, that means 1.5. 1.5 into 8 will give 12. 12 plus 2 will give 14%. Not the 10% market, because our company is more risky than the market. This is the purpose of beta. Measure the risk of share relative to the market. How the share react relative to the reaction of the market. If the market goes up and goes down. So beta could be negative or positive. It will be negative if the share goes against the trend. If the market increase, our share decrease. If the market decrease, our share will increase. This is, we have negative beta. It measures the variability of return. That means the daily return of the market. My share yesterday is $10, today is $11. That means it is increased 1. 1 divided 10, that means 10% return. The next day, it will vary again. This is the meaning of variability of return. The return keep changing day after day. So we measure that variability, but against the market. The higher the variability, the higher the risk, and vice versa. It makes sense. So risk simply means the variability of return. If the return is stable, it increases by the same amount and decrease. We call this a stable company. The risk is very low. The variability is of return. The higher the variability, the higher the risks, the higher the beta. How to measure beta? How do we find beta? We normally get it in the exam, but in real life, we check the return of the market against the return of the company we are interested in. How we do it? Let us go to Yahoo Finance and do a practical exercise. Okay, in Yahoo Finance, we write the name of the company in the search engine, and I chose a company called Bobmatic because it has beta of exactly 1 or almost 1, which that means this company move exactly on average with the S&P 500, the whole market. So it has a beta of 1, and beta here is measured over a period of 5 years, taking monthly data. Okay, I chose another company, which is Verizon. This is a relatively stable company with very low beta of 39. So we expect on average this company move less than 50% of the change in the market. So if the market changed 10% overall, we expect on average Verizon company to move 3.9% instead of 10% like the market. So this is very mature company, very stable. Now, how do we calculate the beta if we want the beta for different time? We go to historical data. We click here to find the data for the last 5 years. Let us select starting date, November 1st, 2018 until October 31st, 2023. This is exactly 5 years. Done. We select here instead of daily data, we select monthly data and then apply. After that, we download the file here. It appears in this way: date, opening, high, low, close, and so on. So I already did this for you. It is here. What we do normally, we calculate the daily return. This is the closing of the stock on 1st of December minus yesterday closing, which is the end of last month, divide last month. In this way, you get the monthly return on the stock. Okay. Now we go to S&P 500 also, which I downloaded here, and I calculate the daily return for you. It is here. So we take this daily return, copy, we go back to our company and put them together. Now to calculate beta, just equal slope y, comma, s. Y is the dependent variable, which is stock return, and comma, then we put the market return. In this way, we measure how our stock reacts to a change in the market. So it is, let us say 37, which is close to 90, 39.39, which is calculated here. You can see Verizon had 0.39. What I got is 0.37, which is close to that. Maybe the difference due only to the timing I start. There is another way using regression. We go to data analysis. By the way, regression is part of a quantitative method, which is part of level 1 syllabus. Regression. Then y-axis is this, which is the stock, and then the axis x is the stock market. Let us have the output here, and here you can see this is the value we just got. This is 366. It is the same 3667, 3667. So there is two ways of calculating beta. Either you use the formula of slope, simple slope. This is y, and this is x. Here also we could use the regression model. Thank you.